Welcome to the Deep Dive. Today, we're going deep on a topic that's clearly on your mind.
Yeah.
How the Fed, the Federal Reserve, how their interest rate cuts ripple through the stock market and the economy as a whole. And wow, you've given us some really fantastic sources to work with here. I'm excited to dig in.
It's a super interesting relationship to understand, and I think can really give you a good edge, just in navigating the financial world.
Totally. So let's dive right in.
Let's do it.
All right. We'll uncover how these rate cuts, impact everything from like your day-to-day spending habits to like big corporate investments.
Yeah.
And even kind of go back in time a little bit, explore some examples like the '08 financial crisis,
Yeah.
the COVID-19 pandemic.
Yeah.
Get ready for some serious aha moments.
Definitely. Some aha moments. Let's first maybe decode what the Federal Reserve, or as it's more commonly called, the Fed, what they actually do when they cut rates. You might have heard about the federal funds rate.
Okay, yeah. I've heard that term thrown around, but I'll be honest, it sounds a little intimidating.
Yeah, no, it's simpler than it sounds. Basically, it's the interest rate that banks charge each other for lending money overnight.
No.
When the Fed cuts this rate, it kind of sets off a chain reaction, right? That lowers borrowing costs across the whole economy.
So it's like kind of like a domino effect, right? Starting with the banks and then it spreads to like
that's a great way to
businesses and individuals.
Yeah, exactly. Think of it like this.
Okay.
When banks can borrow money more cheaply, they can then lend it out to, businesses and individuals at lower rates too, right? So this encourages more borrowing, more spending, which can really help stimulate the economy, when things are slowing down.
That makes sense. But how does the Fed actually go about like lowering the federal funds rate?
Right.
It's not like they just like snap their fingers and it happens.
No. It's not magic. They use a process called open market operations, and it involves buying government securities from banks.
Okay.
So this injects money into the banking system, increasing the supply of reserves and making banks more willing to lend at those lower rates we talked about.
Okay. So it's kind of like adding more fuel to the economic engine, right?
Yeah.
So more money available to lend means businesses and individuals can borrow and spend more freely.
Exactly. But here's where it gets even more interesting.
Okay.
This process doesn't just happen overnight, right? Banks adjust at different speeds, and some are hesitant, to lower their rates right away. So it creates this complex web of effects that kind of ripples through the financial system.
So it's not like a simple cause and effect,
right?
Domino situation.
It's not that simple. It's much more nuanced.
Yeah.
And that's why understanding these nuances can be so valuable, because you can sort of anticipate how different parts of the economy might react and make better decisions, right?
Now, I see what you meant when you said this can really give you like an edge.
Exactly.
It's kind of like being able to peek behind the curtain of the financial world a little bit.
100%. Now, we've talked about the how of the Fed cuts rates, but let's talk about the why they do it.
Yeah, that's what I was just thinking. It's clearly a really powerful tool.
Yeah.
So they must be using it, pretty strategically.
Absolutely. One of the primary reasons is to stimulate the economy during those periods of slow growth, right? When things aren't looking so good. So lower interest rates can encourage businesses to invest, to expand, lead to more job creation, increase economic activity.
So it's like giving the economy a little nudge when it needs a boost.
Exactly. Another reason, a key reason, is to kind of stabilize the financial markets, right? During times of crisis, like we saw in 2008 or the COVID-19 pandemic. So rate cuts can help prevent a panic. And restore confidence in the financial system.
Yeah, so it's like a tool they can use to calm the waters.
Exactly.
When things get a little choppy.
You got it. But remember, rate cuts aren't a cure-all, right? They have to be used carefully in conjunction with other policies to really address those underlying economic issues.
Yeah, it sounds like a delicate balancing act for sure.
It is, 100%. And that's why the Fed's decisions are so closely watched, right?
Right.
By, investors, economists around the world.
It makes sense, All this talk about the Fed, interest rates, it's super fascinating.
Yeah.
But I know you're eager to hear how this all links back to the stock market.
Yes.
So let's shift our focus there. One of the sources you provided mentioned how like lower interest rates can like directly affect a company's profitability.
Right.
Can you break that down a little bit more?
Of course. It really comes down to borrowing costs.
Okay.
When interest rates fall, it becomes cheaper for companies to borrow money for investments, for expansions, even just to manage their day-to-day operations.
Right. So if their expenses go down because they're paying less interest on their loans,
Exactly.
that means they have more profit left over, right?
Bingo. Exactly. And that increased profitability, that can make a company's stock more attractive to investors.
Okay, that makes sense. But it's not just about companies, right? Like lower rates.
You got it.
I'm assuming they affects our spending habits too.
Right. Absolutely. 100%.
Okay.
Think about things like, credit cards, car loans, mortgages.
Right.
When interest rates drop, those all become more affordable.
Yeah.
Which frees up, more money in your budget.
Right. It's like getting a little breathing room.
Exactly.
Financially, right?
Yeah.
So maybe you can finally like take that vacation you've been saving for, or even invest some of that extra cash in the market.
100%. And all of this increased consumer spending can actually boost company revenues.
Right.
Leading to, higher profits, potentially higher stock prices.
So it's like a virtuous cycle.
Right. Yeah.
Yeah.
So lower rates stimulate spending, benefits companies, which then benefits investors. It's all connected.
It's all connected. But just like, just like with anything, there's two sides to every coin.
Right.
Right. So while these lower rates can boost the economy, can boost the stock market, there are some potential downsides.
Okay, let's talk about that. What are some of the risks?
Yeah, sure. One of the big concerns is the potential for excessive debt.
Okay.
Right. So when borrowing is cheap, it can be tempting for both companies and individuals to take on more debt than they can handle. Yeah. It's like using a credit card to buy things you can't afford.
Exactly.
Might seem okay at first, but can quickly spiral out of control.
Absolutely. And if too many companies, too many individuals take on too much debt, it can create these systemic risks for the whole economy.
It's all about finding that balance. Enjoying those benefits, of lower rates.
Exactly.
But without getting in over our heads.
Exactly. You got it. And that's where, informed decision-making comes in.
Right.
Understanding how these dynamics work, the benefits, the risks, that can really help you make, smarter choices about your finances, your investment.
For sure. So far, we've talked about how these rate cuts affect, companies and consumers over time. But what about the immediate reaction, like in the stock market?
Right.
When the Fed announces a rate cut, I'm imagining things get a little volatile, right?
Oh, absolutely. The stock market can react very quickly and often unpredictably.
Yeah, one of the articles you sent described it as like a roller coaster ride.
Yeah, that's a great way to put it. Imagine a room full of people.
Okay.
Each with their own opinion, interpretation of what this rate cut means for the economy.
Okay.
For the future. Right.
Yep.
Some might see it as a sign of strength, while others might see it as a sign of weakness.
So you've got this mix of like optimism and pessimism swirling around.
Yeah, exactly.
And it just translates into a lot of, buying and selling.
Exactly. And this is where what we call investor sentiment really comes into play.
Like how people are feeling about the market.
Exactly. How people feel.
Got it.
If enough people believe the rate cut is good news, the market might surge upward.
Okay.
If enough investors are worried, it might plummet.
So it's like everyone's trying to figure out if the Fed's making the right move.
Exactly.
And that uncertainty just leads to a lot of price fluctuations.
Exactly. And to add another layer of complexity, not all sectors of the stock market react the same way.
Okay. So it's not just like a rising tide lifts all boats.
Nope.
Like some sectors might actually benefit.
Exactly.
While others might take a hit.
Precisely. For example, sectors like real estate. Or utilities. They often do well when rates are lower. They tend to rely on debt financing. So lower interest payments can boost their profits.
Makes sense. So for those sectors, a rate cut's like a direct boost to the bottom line. Yeah. But you said some sectors might actually be hurt by a rate cut.
That's right. Financial institutions. like banks,
Okay.
can sometimes be negatively impacted.
Okay.
Their business model is lending money, right? Earning interest.
Yeah.
So when rates fall,
Yeah.
their profit margins can get squeezed.
I see. So lower rates might be good for borrowers, but
Right.
not so good for the lenders.
Not so much for the lenders, yeah.
Got it. So understanding how different sectors react,
Right.
that can help you make like more strategic investment decisions.
Exactly.
Right. Like maybe shift your portfolio around a little bit based on what you think might benefit
100%.
versus what might take a hit.
Yeah, absolutely.
Wow. It's amazing how much nuance there is to all of this.
Yeah, there's a lot.
And we haven't even touched on the long-term effects of rate cuts on like stock valuations. But before we get into that, why don't we take a quick break?
Sounds good.
And we'll be right back to dig even deeper into how the Fed's actions impacts the stock market.
Let's do it.
All right. Welcome back to the Deep Dive. Before the break, we were talking about how rate cuts can have these different effects on various sectors of the stock market. But now I'm kind of curious to explore the long-term impact of rate cuts on like stock valuations. It's honestly kind of a mystery to me.
Yeah, it's a fascinating area, one that often gets overlooked, in the rush to analyze those immediate market reactions. But really understanding those long-term effects can give you a much deeper understanding of how the market really works.
Okay, I'm all ears. Where do we even begin?
Well, one key concept to grasp is how lower interest rates can impact a company's valuation through something called discounted cash flow analysis, or DCF for short.
I think I saw that term in one of the articles you sent.
Yeah.
But to be honest, it sounded kind of intimidating.
It can seem that way at first, but the basic idea is pretty straightforward. Imagine you're a business owner.
Okay.
And you're trying to figure out how much your business is worth today.
Okay.
You would look at how much profit you expect to make in the future.
Right. The more profit I expect to make in the future, the more valuable my business is today.
Exactly. But here's the catch. Money today is worth more than money in the future.
Right. Okay.
Think about it. If you had $100 today, you could invest it, earn interest.
Right.
If someone promised you $100 a year from now, it wouldn't be worth quite as much because you missed out on that year of potential earnings.
Yeah. Time is money, as they say.
Exactly. Exactly. And that's where discounting comes in. So DCF analysis takes into account this concept of time value of money by discounting those future cash flows back to their present value. And this is where interest rates play a key role. So the lower the interest rate, the less those future cash flows are discounted, making them look more valuable today.
So it's kind of like buying something on sale, right? Like the lower the discount,
that's a great
appealing the price.
Yeah, that's a great analogy.
Yeah.
And just like with a sale, lower interest rates can make a company's stock look more attractive to investors, potentially driving up its price.
Okay, so I'm starting to see how this all fits together, but I have to ask, if lower rates make those future cash flows look more valuable, could that lead to inflated stock prices?
Yeah, that's a very important point. And one of the risks we have to be aware of, when interest rates stay low for a long time, it creates this environment where investors are willing to pay higher and higher prices for assets, even if those prices get detached from the underlying, fundamentals.
So it's like bubble forming, right? Like people get caught up in the hype, keep bidding up the price, even though it might not be justified.
Exactly. And when those bubbles eventually burst, as they always do,
it
leads to painful market corrections.
Right. So it's important to be aware of that, watch out for those.
Exactly. Don't get swept up in the hype.
Right. Okay. So we talked about how those lower rates can affect a company's valuation through the DCF analysis, but is there anything else that impacts it, in the long term?
Sure. Another key factor is how those lower interest rates can impact a company's earnings growth expectations. So when borrowing costs are lower, companies have more financial flexibility to invest in R&D, to expand into new markets, to make strategic acquisitions, all things that can drive future growth.
So it's like giving companies more fuel to power their growth, their growth engines.
Exactly. And that potential for increased earnings growth, again, makes that stock more attractive to investors, leading to potentially higher valuations.
It's amazing how it all kind of fits together. Lower rates, profitability, boosting that perceived value of future earnings, fueling those growth expectations. It's a powerful combo.
It is a powerful combination, but it's important to remember it's not a guaranteed outcome.
Right.
There's always those other factors at play, like competition, technological advancements, overall economic conditions.
Yeah, so it's never as simple as lower rates equal higher stock prices.
Yeah.
There's always other variables.
Absolutely. And one of those variables is the impact of rate cuts on what we call dividend stocks.
Okay, yeah.
So these are stocks that pay out a portion of their profits to shareholders regularly, and they can become particularly appealing to investors when those interest rates are low.
Yeah, it makes sense. If it's harder to find decent returns from like your traditional investments, bonds, when interest rates are low, investors might be more drawn to those dividend stocks for that steady income.
Exactly. That's exactly what happens.
Yeah.
And that increased demand can push those prices up, even if the company's fundamentals haven't changed much.
So there's like that element of speculation there too, right? They're like betting those dividend stocks will continue to perform well.
That's right. And that speculation can create its own dynamics in the market.
Sometimes driving prices beyond what's like fundamentally justified.
Exactly.
So we got to be careful about getting like caught up in the hype.
Absolutely. It's always crucial to do your homework, understand the underlying fundamentals of that investment you're considering, and be aware of that role speculation is playing in the market.
Right. Okay. So far we talked about like the direct effects of rate cuts on companies, consumers, the stock market, and how those effects, ripple through the economy over time. But there's another layer here.
Yes.
I'm really curious to unpack. And that's like the role of speculation and anticipation.
Yes, it's a fascinating part of the market. Almost as if the market itself becomes a player in this game, trying to predict the Fed's next move.
Yeah, and one of the sources you sent me used that term, self-fulfilling prophecy.
Oh, yeah.
It's like the market starts to move in anticipation of a rate cut.
Yeah.
Even before the Fed's like made an official announcement.
Exactly. It highlights that psychological dimension of the market, right?
Yeah.
Where beliefs and expectations can influence those outcomes.
So it's not just about the actual rate cut itself. It's about the anticipation of it.
The anticipation of it, exactly. Okay. And this is where the big players, like hedge funds, institutional investors, really come into play.
Okay.
They've got vast resources, sophisticated models trying to predict the Fed's actions, and their bets can have a significant impact on market movements.
It's like this high-stakes poker game, right?
It is.
Where everyone's trying to outguess each other.
Yeah.
How does this anticipation game actually work in practice?
So imagine this. You've got a hedge fund manager who believes the Fed is likely to cut rates at their next meeting. Based on that belief, they start buying up stocks that they think will benefit from those lower rates.
So they're making a bet on the future direction of those interest rates.
Exactly. And if enough investors share that belief and start buying those same stocks, it creates upward pressure on prices even before the Fed makes an announcement.
So it's like the market's front running the Fed's decision.
Exactly.
Based on like expectations and
that's a great way.
And speculation.
It's a great way to put it.
And that anticipation game can actually influence the Fed too, right?
Absolutely.
If the market is already pricing in a rate cut, the Fed might feel pressure to follow through.
That's right.
Even if they weren't initially planning on it.
Exactly. It's that two-way street.
Yeah. The market tries to anticipate the Fed's moves, and then the Fed has to consider the market's expectations.
It highlights that interconnectedness of the whole system.
For sure. Okay, I'm starting to understand how all of this fits together.
Yeah.
But how do those rate cuts play out in the real world?
Right.
Like, do they have a tangible impact on things like jobs or housing?
They do. So one of the main goals of cutting rates is to stimulate job growth.
Okay.
So when borrowing is cheaper, businesses are more likely to invest, expand, hire more workers.
So it's like giving the job market a little boost.
Exactly. But it's not always that simple.
Right.
There's other factors that can influence job creation.
Okay.
Things like technological advancements, globalization, changes in consumer demand.
So while those rate cuts can create a more favorable environment for job growth.
Yes.
It's not like a guaranteed solution.
It's not a guaranteed solution. Speaking of jobs,
Yeah.
have you noticed any changes in your field since that last rate cut?
Actually, now that you mention it, it does seem like more opportunities are popping up now than there were like a few months ago.
Yeah.
Hard to say for sure if it's directly related to the rate cut, but interesting timing.
Interesting timing. Now, let's shift gears and talk about the housing market.
Okay.
You know, we talked about how those lower rates can make mortgages more affordable.
Right.
Does that actually translate into more people buying homes?
That's a great question. I'm curious to hear your thoughts on that.
Well, it often does.
Okay.
You know, lower mortgage rates make buying a home more attractive, especially for first-time buyers, you know, those who might have been priced out before.
Right, yeah.
So this increased demand can then lead to higher home prices, which can create this sense of optimism.
Right. But we also need to be careful about creating another housing bubble, right?
Absolutely.
We've seen how that can end badly.
You're 100% right. It's crucial for policymakers to strike that balance, you know?
Yeah.
Stimulating the housing market, but preventing that excessive risk-taking.
Yeah. It sounds like another delicate balancing act.
It is. And that's why it's so important to monitor that housing market and look for signs of overheating.
Right.
Like rapid price increases or that surge in speculative buying.
Okay. So rate cuts have a real impact on the job market.
Yes.
The housing market.
Absolutely.
But we can't forget about inflation, right?
That's right.
Doesn't cutting rates risk pushing prices up?
That's a crucial point. One of the biggest challenges for central banks. When the economy heats up and the demand for goods and services increases, it can lead to inflation, right? And rate cuts, by stimulating demand, can actually contribute to that inflationary pressure.
So it's like this delicate balancing act.
It is.
The Fed needs to find that sweet spot where they can stimulate growth, but not, let that inflation get out of control.
Exactly. And that's why they're constantly monitoring a wide range of economic indicators.
Okay.
Inflation, job growth, consumer spending to make the best decisions.
Yeah, it sounds like a complex and challenging job.
100%. But understanding those dynamics can help you make more informed decisions, about your finances, your investments.
Right. Okay, so we've seen how these rate cuts impact, the economy broadly. But what about specific sectors?
Right.
Are there clear winners and losers?
That's a great question.
When the Fed lowers rates.
It is a great question, and one that savvy investors pay very close attention to. As we talked about earlier, different sectors, they react differently to those changes in interest rates. Some thrive while others struggle.
So it's not a one-size-fits-all.
It is not.
It is not.
Let's take the financial sector, for example. Lower rates can be a mixed bag for financial institutions like banks. On the one hand, lower rates squeeze their profit margins because they're earning less interest on those loans. But on the other hand, those lower rates can also stimulate demand for loans. So that could be good for their business.
So it really depends on the specific institution and how they adapt.
Exactly. It's important to look beyond just that sector as a whole and analyze individual companies to really see how they're positioned.
Yeah, that makes a lot of sense. What about other sectors? How do technology companies typically fare when those rates are falling?
Well, technology companies often thrive in these low-rate environments. They tend to be growth-oriented and really rely on access to capital for innovation expansion. So lower borrowing costs make it easier for them to pursue those activities.
It makes sense. They can kind of invest more aggressively when that money is cheap.
Exactly.
Okay, now I'm curious about consumer discretionary versus consumer staples. How do those sectors fare during these rate cut cycles?
That's an interesting comparison. So you've got your discretionary goods. Those are things like cars, appliances, entertainment.
Okay.
And then you've got your staples like food and household products.
Right.
So when interest rates fall and people are feeling more confident about the economy, they tend to spend more on those discretionary items.
Makes sense. So discretionary spending goes up when people are feeling good about the economy, have more money to spend.
You got it.
Which often happens when rates are falling.
Exactly. And that's why those consumer discretionary stocks might do well while consumer staples might lag behind.
Interesting. Okay, I'm starting to get a better sense of how these sectors react. Before we wrap up, I want to touch on one more thing. The global ripple effects of the Fed's actions, right? It's not just a U.S. story.
You're 100% right.
Right.
The Fed is the most powerful central bank in the world. And its decisions have implications for the whole global economy. When the Fed cuts rates, it impacts everything. From currency exchange rates to capital flows between countries.
One of the sources you sent me mentioned that emerging markets can be both beneficiaries and victims of U.S. rate cuts. How does that work?
So it's an interesting dynamic.
Okay.
On the one hand, lower U.S. interest rates can make it cheaper for those emerging market companies to borrow money in U.S. dollars, which can stimulate investment and growth in those countries.
So it's like a spillover effect, right? Like the benefits here in the U.S. can flow to other parts of the world.
But on the other hand, those emerging markets can also be vulnerable to those sudden outflows of capital when those U.S. rates start to rise again.
I see. So if investors sense that, higher returns are available in the U.S., they might pull their money out of emerging markets. Causing, instability.
That's the risk. And it's something that those policymakers and investors in emerging markets really need to be aware of.
Yeah. So it's a complex picture. U.S. rate cuts can create both opportunities and risks for these markets.
Absolutely.
What about currency fluctuations? How do those play into that global impact?
That's another important piece of the puzzle.
Okay.
When the Fed cuts rates, it can cause the U.S. dollar to weaken relative to other currencies. This can then make U.S. exports more competitive. Because they become cheaper for buyers in other countries.
But wouldn't that also make imports into the U.S. more expensive?
Exactly.
Which could lead to, more inflation.
You got it. So there are those trade-offs to consider.
It's fascinating how interconnected everything is.
100%.
And it highlights why it's so important to, have that global perspective when we're analyzing, the impact of these Fed rate cuts.
100%.
What happens in the U.S. doesn't stay in the U.S.
It does not.
It ripples out to the rest of the world.
Absolutely.
Speaking of history, I'm really curious to kind of learn from those past rate cut cycles,
Absolutely.
It's one thing to understand the theory, but it's another to, actually see how it's played out.
I agree.
In the real world.
History often provides those valuable insights, those lessons that can help us understand the present and anticipate the future.
Okay.
So why don't we take a trip down memory lane?
Okay. All right.
Explore some key historical case studies.
All right. I'm ready to fire up the time machine.
All right.
Where are we heading first?
Let's start with a trip back to 2008. The year the global financial system nearly melted down.
Ah, yes. The 2008 financial crisis.
Yes.
I remember it well. No, I wouldn't want to relive it.
No.
What happened with interest rates back then?
So, facing a rapidly deteriorating economic situation, the Fed took unprecedented action. They slashed those interest rates to near zero in an attempt to stabilize markets and prevent a complete collapse.
So they went all in.
They did.
On those rate cuts, just hoping to stop the bleeding.
They did, but it's important to understand that rate cuts alone couldn't solve the problem. You see, the crisis was rooted in these complex financial instruments, excessive risk-taking, a lack of regulatory oversight.
Yeah, it's like a house of cards built on a shaky foundation.
Exactly. Rate cuts might have helped to prop it up temporarily, but they couldn't fix those underlying issues.
So what else did we learn from that tumultuous period?
Well, the 2008 crisis really underscored the importance of diversification for investors.
Yeah.
Those who had all their eggs in one basket,
Yeah.
particularly in those sectors heavily exposed to the housing market,
Right.
suffered big losses.
Yeah. Ouch. It's a painful reminder that spreading your risk is crucial, especially during times of economic uncertainty.
100%. And the crisis also highlighted the importance of liquidity.
Okay. Yeah.
Having access to cash when the markets are in turmoil can be the difference between weathering the storm and being forced to sell assets at a loss.
Okay. So 2008 was a harsh but valuable lesson.
Yes.
In the limits of these rate cuts and the importance of being a prudent investor.
100%. Let's fast forward to the COVID-19 pandemic.
Okay.
What happened with interest rates then?
Okay.
So the pandemic presented a completely different kind of crisis,
Right.
A global health crisis that shut down economies worldwide.
Mm-hmm.
The Fed, once again, took swift action.
Okay.
Slashed rates to near zero.
Okay.
And implemented this massive bond buying program.
Okay.
Known as quantitative easing.
Quantitative easing. That's another one of those terms I've heard.
Yeah.
But don't fully understand. What does that actually mean?
So it's a bit like open market operations on steroids. Instead of just buying government securities from banks, the Fed's also buying other assets.
Okay.
Like mortgage-backed securities to inject even more liquidity into the financial system.
So it's like they're flooding the system with money to just keep things afloat?
You got it. And in this case, the response seemed effective.
Okay.
Equity markets rebounded relatively quickly after that initial shock.
Okay.
And the economy began to recover, albeit unevenly.
Yeah. I remember it felt like the world was ending in those first few months of the pandemic.
Yeah.
But then, almost miraculously, the market started to climb back up.
It was a remarkable turnaround.
Yeah.
And, while many factors were at play, the Fed's swift action, those rate cuts, the quantitative easing, undoubtedly played a role in restoring confidence.
So what's the key takeaway for investors from that whole COVID-19 experience?
I think it just reinforces the importance of maintaining a long-term perspective. Panicking and selling everything when the market tanks is rarely a good strategy.
Right, right.
Those who stayed calm, rode out the storm, were often rewarded.
Right. So it's a good reminder that sometimes the best course of action is to do nothing.
Exactly.
Resist that urge to react emotionally to those short-term market fluctuations.
Yeah.
Easier said than done, though.
Oh, yeah. Much easier said than done.
It can be challenging.
Yeah.
But understanding how markets have behaved in those past crises can really help us make those more rational decisions when we're faced with uncertainty.
Okay. So we've looked at two major crises.
Yes.
And how the Fed used rate cuts to kind of navigate those turbulent times. What about broader patterns from, previous decades? Yeah. Are there any recurring themes or lessons we can kind of glean from those experiences?
Absolutely.
Okay.
So if we take a step back and look at rate cut cycles throughout history, we see this recurring pattern of boom and bust.
Okay.
So periods of low interest rates often lead to periods of excessive risk-taking.
Okay.
Asset bubbles.
Okay.
Followed by those painful corrections when those bubbles burst.
It's like we never learn our lesson, We get seduced by the easy money, the cheap credit, and then we get burned.
Exactly.
When things inevitably go sour.
It's a tale as old as time.
Yeah.
Unfortunately. But by studying those patterns, we can at least try to be more aware of those risks.
Right.
Make more informed decisions.
So it's about recognizing the signs of an overheated market, right? Like sky-high valuations, unsustainable levels of debt.
Exactly.
Being prepared to adjust our strategy accordingly.
Exactly. It's about being a student of history. Understanding that cyclical nature of the market.
Right.
And not getting caught up in the euphoria.
Yeah.
When everyone else is rushing in.
Okay. I'm starting to see like a common thread here.
Yeah.
Running through all these examples, there seems to be this real danger in becoming too reliant on those low interest rates, like as a crutch for the economy.
That's a very astute observation.
Yeah.
And it's something we need to talk more about.
Yeah.
Low interest rates can be a powerful tool to stimulate growth,
Right.
but they're not a substitute for sound economic fundamentals.
Right. It's like giving someone a sugar rush.
Yeah.
Might give them a temporary boost of energy.
Exactly.
But it's not sustainable.
That's a great analogy. And in the case of low interest rates, that sugar rush can lead to some serious long-term consequences.
Okay, let's talk about that. What are the dangers of, becoming too reliant on those low interest rates?
So one of the biggest risks is that formation of those asset bubbles we talked about. When money's cheap and credit is easy to come by, investors just tend to chase returns.
Oh, okay.
Bidding up asset prices to these unsustainable levels.
We've already seen that play out in the housing market.
Yes.
But it can happen in other asset classes too, right? Like
absolutely.
Stocks, bonds, even crypto.
Any asset can become a bubble if there's enough speculation and easy money.
Right. And when those bubbles burst, the consequences can be pretty devastating.
Absolutely. It's like blowing up a balloon too much.
Yeah.
Eventually it pops.
And those pops, those market corrections can wipe out years of gains, you know, in a very short period of time.
Exactly. Another major concern is inefficient capital allocation.
Okay.
When interest rates are artificially low, it distorts the signals that would normally guide investment decisions.
Can you elaborate on that?
Sure. So normally, investors and lenders, they assess the risk. The potential return of a project before deciding whether to fund it.
Yeah.
But when money is cheap, readily available, those assessments become less rigorous.
So projects that wouldn't normally get funded might get the green light simply because borrowing's so cheap.
Exactly. It's like funding bad ideas just
because the money's there.
Exactly.
And that can actually have a negative impact on long-term economic growth.
Absolutely. When capital is misallocated, it means fewer resources are available for those truly innovative, productive projects.
So those low rates might, give the economy that short-term boost, but they could hinder our long-term results.
That's the risk. And that's why it's so important for the Fed to find that balance between stimulating growth and maintaining financial stability.
Right. It's a tricky balancing act, that's for sure.
It is.
So what does all of this mean, for investors? How do we navigate this complex world, of the rate cuts, the market reactions, the potential for boom and bust?
That's the million-dollar question.
Yeah.
And it's definitely something to think about as we kind of wrap up this deep dive.
Yeah. We've covered a lot of ground today, from the mechanics of how the Fed cuts rates to those historical patterns of boom and bust. We've explored, the impact on companies, consumers, the global economy. But maybe the most important takeaway here is that there's no one-size-fits-all answer.
Exactly.
This relationship between interest rates and the stock market, super complex, constantly evolving, influenced by countless factors.
100%. There's no magic formula. No crystal ball.
Yeah.
But by staying informed, doing your research, understanding that historical context, you can develop a framework for making those smarter investment decisions.
Absolutely. To our listener, I think that's a great place to wrap up this deep dive. What were your key takeaways? Anything surprise you? Challenge your assumptions. Spark some new ideas. Keep those questions in mind as you continue to explore this truly fascinating topic. And be sure to join us next time for another deep dive into a topic that's important to you. Until then, keep learning, stay curious, and happy investing.